Hi, my name is Justin, and today I'll be sharing more with you about the FACC CA1 assignment. Firstly, for the journal entry, as stated in the Word document, the auditors renegotiated their audit fees to 8,500 for the financial year. Therefore, we have to debit audit expense because it's an expense incurred for auditing, and we credit a provision for audit fees. The next journal entry will be stated. The company engaged a consultant who valued the land at 800,000 as at 30th April 2020. As this is a revaluation by a third-party consultant, the land has increased by 50,000 as it was 750,000 to 800,000. Therefore, we debit land of the difference, which is 50,000, uh, and then we credit the land revaluation reserve as the land has increased in price, and therefore we store the money in the land revaluation reserve for revaluation. Next, the question states that 20,000 worth of debentures were issued on 1st August 2019 with interest rate of 2% per annum to be paid semi-annually on 1st August and 1st February each year. Therefore, we have to calculate this, we have to use 20,000 times the 2% per annum times 3 over 12, as we take from 1st February to 31st April, which is the financial year as at now. Next, the line reads, the debentures of 30,000 issued in the previous year had interest rate of 3% to be paid semi-annually on 1st January and 1st July each year. Therefore, we have to take 30,000 times 3% as times 4 over 12, as we have to take the month at 1st January to 31st April. If we add them up, it will be $400, and therefore we debit interest expense as we have to pay the interest to the users, and then we have to credit debenture interest payable as we have to pay them. Next, the question states that for 1st August 2019, the company declared and paid interim share dividends of 2 shares for every 10 shares at $1 per share. This has not been recorded. As such, it will be both ordinary share capital and preferential share capital holders will be affected. Firstly, we have to debit retained earnings because to pay dividends, that's where we have to use accumulated profits of the company. As there are 200,000 ordinary shares, we have to divide this by 10 and times 2 as per the question states, and times the $1. So we have to debit retained earnings, which is 40,000. Then we have to credit ordinary share capital 40,000 as shares are being issued, which is an interim share dividend. This also applies for the preferential share holders, which you will get a figure of 24,000, where you debit retained earnings 24,000, credit preferential share capital 24,000. Next, on 1st January 2020, the company issued a rights issue of 1 for 4 shares at $1.20 per share, and all ordinary shareholders existing on this date are eligible to apply. All the rights were fully subscribed, and this has not been recorded. Okay, so this is a rights issue, and all ordinary shareholders existing on 1st January 2020 is allowed to subscribe. As such, we have to add the figure from the previous question, which is 40,000, as a ordinary share capital of 40,000 was given on 1st August 2019. Therefore, 240 to find the amount, we have to take 200,000 plus 40,000, which is 240,000 divided by 4 times $1.20 per share, which is 72,000. Therefore, we have to debit the bank 72,000 and credit ordinary share capital of 72,000. Next, the question reads that tax at 17% for the financial year has not been provided. As such, actually taxation is sort of like an expense. So we have to debit taxation 37,417, which is 220,100 times 70%, which is equal to that amount. For the next journal entry, the question states that on 30th April 2020, the directors declared final dividends of 5 cents per share to its ordinary shareholders, and dividends on preference shares were declared and paid. These dividends have not been recorded. Since it is a dividend payout, therefore we debit retained earnings, and there is 200,000 holders of ordinary share capital. Therefore, we take 200,000 times 5 cents, which is 10,000 plus 150,000 of preference share times 4%, which is 6,000. Therefore, we debit retained earnings 16,000, and then we credit bank 16,000 as we have already paid them. For the next question, question 2, it starts by saying that credit sales of $55,800 were omitted from the records. Therefore, to correct this, we have to debit accounts receivable 55,800 as we will be receiving the money, and we should be receiving the money. As this is a credit sales, it is accounts receivable. As products were sold, we have to credit sales revenue 55,800 as the company had made the sale. Next, it states that depreciation for furniture for December was recorded as $15,110 instead of $11,550. So there is a difference of $3,560, and we recorded more depreciation than we should have been of this $3,560. Therefore, to reverse the difference out so that it's the correct $11,550 for depreciation, we reverse the standard depreciation journal entry. Therefore, we debit accumulated depreciation 3,560 and we credit depreciation expense 3,560. For the next question, it states that an additional provision of $18,260 for allowance for impairment of receivables was debited to rent expense. By right, to record allowance for impairment of receivables, impairment loss on receivables should be the expense which is debited. Therefore, to correct this, we have to debit impairment loss on receivables $18,260. We have to reverse out the rent expense, which is when we credit rent expense. Next, it states that monthly maintenance fees for factory machinery amounting to $12,000 for the whole year was debited to factory machinery account. This is wrong. Therefore, we have to debit maintenance fees or the expense, which is $12,000, and we credit machinery $12,000 as it should be recorded as an expense and not to the asset. Next, we are given the following information on revaluation. The amount has been revaluated from 820,000 minus accumulated depreciation to 300,000. Therefore, to record this, we have to debit the revaluation reserve of 20,000 and debit loss on revaluation, which is 8,000. And we have to credit building 28,000 as we lost 28,000 value of the building.